Hey, good afternoon, everybody. It's Larry Luna with South Pacific Financial with this week's mortgage message video. And today I wanted to talk about income. I had a couple questions this week regarding some income questions, and I'll kind of give you an example of what we had in the scenario that we encountered this week. But I also wanted to let you know about different forms of income, because different forms of income require different types of analysis. For example, W-2 and salary income, meaning somebody that has a standard salary that they receive every other week, twice a month, bi-weekly, and then they typically get a W-2 for that income at the end of the year, or a standard hourly employee who basically has the same thing and is issued a W-2 at the end of the year. Those are calculated in one particular way. We would usually get a verification of employment, take 2 years and the year-to-date income from their employer that's verified, average that out. So like, let's say, for example, we're in March of 2018. I would take a 2016, a 2017 W-2, add those together, add in the year-to-date for 2018 for January, February, and just 2 weeks of March, and then add that into basically, or average that out over about 26 and a half months to get a monthly average, and that's the gross income that we would use. Keep in mind that would include any type of bonus or overtime and commission that's combined. One key thing to remember, though, is if you are a majority commissioned employee and 25% of your income is a result of your commissions, we're also going to need tax returns. We're going to have to show what kind of expenses that you write off, because obviously if you're making that much in commissioned pay, there's probably going to be some write-offs along with that. So if you're speaking with a client who is strictly commission-based only, and the majority, or salary plus commission, but the majority of that commission is 25% or more of that income, we're going to need tax returns. Other forms of income are 1099 income, which can consist of some type of disability, Social Security, retirement, anything other than W-2. There's a specific format for us to analyze and get an average gross income for that as well. Typically, they require an award letter for that particular year of Social Security or your retirement, how long it's going to go on for, what's the amount, things of that nature. So we would use that to determine the income. And then one last thing I wanted to share with you is a scenario that we had this week with one of my realtors clients. We had a client who had been working with this job for a little over 8 years. At the beginning of the year in January, she had taken some disability time off and is planning to return back to work, but it won't be until about April. So that period of time from January to April, she's receiving disability. We informed her that yes, we can use that income that she's been working with that same employer for the past 8 years. We're going to need to explain what happened and the reason for the disability. But we're also going to get a letter from the employer stating that what specific day is she expected to return and at what rate what she'll be returning at. And then we also cannot close the loan until she actually has her first paycheck from returning back from disability. We need to show that it basically verifies what the letter from the employer said as far as when she started and the pay rate that she's got. So just a couple things that are key and important when analyzing and determining monthly income. If you have any specific questions, feel free to give me a call. I'll be working this weekend as usual. You can reach me at 951-858-0797. Otherwise, make it a productive weekend, and we'll see you next week. Thanks.